Well, welcome. My name is Ward Keever, founder, president, and CEO of Covenant Wealth Strategies, and I'm joined this afternoon by Michelle Fisher. Today is Thursday, November 6, 2025, and we are delighted to have you join us for another installment of our Stone Barn Speaker Series. Today we'll be joined by Graham Kimmerer from MFS. And I'll introduce Graham in just a moment. And we're also thankful to Brian Marks, our MFS relationship manager, for making Graham available to us. If you have any questions during the course of this presentation, please feel free to send them in by email, Michelle with 2 L's at covenantwealthstrategies.com. We'll mention that once or twice more throughout the program. And we actually also have a couple of questions that came in ahead of time, so we'll get to as many questions as we can. So let me introduce to you Graham Kimmerer. Graham has been in the industry after graduating from Gettysburg College, by the way, Graham. I didn't get a chance to connect with you on the Gettysburg connection there. We have a Messiah University alumni who's on our team, and I understand there's quite a fierce rivalry between Messiah and Gettysburg just based on proximity. So Graham joined the industry in 2010 and joined MFS in 2013 as an internal sales representative and was later promoted to a regional sales representative and internal wholesaler. He assumed his current role as a senior strategist of business development in 2023. And in his current role, he helps financial advisors like the team here at Covenant Wealth Strategies grow our practices by providing thought leadership and practice management content, including Social Security and Medicare planning, which is the topic for our presentation today. In his personal life outside of work, Graham is married to Katie, and they live northwest of Boston with their 2 Basset hounds, and they enjoy traveling extensively. They just got back from Scotland, and they're looking forward to an upcoming trip they have planned for Greece. So Graham, without further ado, please feel free to introduce yourself further and take it away with our Social Security presentation. We will mute ourselves and go camera off, but we are going to be right here. So if there's anything that you need, just holler. And at the end of your prepared remarks, we'll come back and facilitate the question and answer time. Thank you, Graham.
Perfect. Thank you so much, Ward and Michelle. Thank you for having me here. Thank you to your entire team for organizing this. But most importantly, thank you all for joining in this evening to have this conversation around Social Security. Normally, the first thing most folks will do when they start thinking about taking Social Security is to review their statement. And your eye would normally be drawn to the top right-hand side of the first page of your statement, which is where you see all those little blue charts up there, because that's where you see your number. That's officially called your primary insurance amount, but that's what you're due at your full retirement age or depending on when you take it. However, to me, that's not the most important part of this whole statement. It's the second page that says Social Security is not intended to be your only source of income when you retire. On average, Social Security is set to replace around 38% of your pre-retirement income. Now, one of the questions that the company I work for, MFS, asks of financial advisors and their clients is outside where is it that you're going to be getting all of your money for retirement? And the number one answer is always Social Security. Following that, the second biggest answer is a bank account. No matter what your bank account is yielding, it's not nearly enough to get you to, let alone through retirement. So it's all the other pieces of the puzzle that you see here: IRAs, 401ks, insurance, annuities, other investments, pension income, all these pieces that the folks at Covenant Wealth can help you put together and piece together to make sure you have the type of retirement you want, you've earned, and that you deserve. But Social Security is going to be a big part of this consideration. So with the time we have available this evening, what I'd like to do is to go over, first up, your personal benefits, a little bit about how they're calculated, and some major considerations for you yourself. Then, if you're married or you have been previously married, we'll talk about benefits for those folks. That's going to be spousal benefits, survivor benefits, and divorce benefits. And lastly, we'll wrap up with a conversation about taxation and Social Security, because believe it or not, the IRS is basically the grim reaper of the US government, and they are still looking for ways to tax your Social Security. But first up, with your personal benefits, the number one thing that you'll always need to know is your full retirement age. This is about to get a lot easier because anyone that's born 1960 or afterwards, your full retirement age will be age 67. But if you were born in some of these in-between years, 1955 through 1959, that can get tricky because it's going to be 66 and a couple of months. It jumps up 2 months for each year born 1955 through 1955, excuse me, 1959. So for those folks that are born in 1959, just as an example, you'll be turning 66 in 2025 by and large. However, you're not going to be hitting your full retirement age until the anniversary of your birthday sometime next year, which can just make that timing a bit tricky. How you qualify for benefits is a little fluky, and it's the top part of the page here, and there's two numbers that are very, very important. In order to qualify, you need to work and pay Social Security Social Security taxes for 40 quarters. Those quarters don't need to be in a row. You just need to have 40 of them all put together. That's going to qualify you. The next number that's really important is directly to the right of that, the number 35. The Social Security Administration is always looking at your highest 35 years of earnings. So it's not your most recent earnings years, the last 10, 5 of the last 10. It is the highest 35 that gets cherry picked throughout the entire course of your work history. And if you're thinking back and saying, you know what, 30, 35, 40 years ago, when I started my career, a dollar does not look like a dollar today. You're absolutely right. And the administration does take that into account. They use a form of inflation to make that as even of a playing field as possible. Now, the number one question that gets asked of financial professionals when it comes to Social Security is when. When should I take my benefit? And it seems like it should be a relatively straightforward question to get answered because you know when you were born, so you know your full retirement age, and you reviewed your Social Security statement, so you know what your benefit amount is. However, a lot more goes into answering it than just those two things. Are you married? Do you maybe have a younger spouse or younger children? How long do you plan to continue working if you aren't yet retired? What does your health look like? What does your family history maybe tell us? What do all of your accounts look like? And how does Social Security feed in to your overall retirement income plan? So, a lot of different variables go into answering what seems like a relatively straightforward question. So, this is never a one size fits all answer. In reality, most folks or most couples usually have several different options for them to consider when taking Social Security. And it's about working with financial professionals to understand the pros and cons of each different approach and what you're most comfortable with. What I can tell you, though, and this is what the charts down below are showing you, is if you take your benefits prior to your full retirement age, all that means is pay cut. You can start taking benefits at 62, but it's going to be a permanent 30% pay decrease. At full retirement age, you get everything. If you go until 70, if that makes sense for you, if you're able to, there is a guaranteed 8% step up year over year between your full retirement age up to age 70 when Social Security absolutely maxes out. When you get a chance to review your statement, take a look at the language that they use here because they say that filing at 62 or 63 is an early filing. And waiting and getting those increases is a delayed benefit. Imagine for just one moment that I'm your pilot, we're sitting on the tarmac, and we're about to set off on your dream vacation. And I said, folks, I have a survey for you. We can either take off and land early, or this flight can be delayed. It's your choice. I'm willing to bet that most people here are going to say, let's take off and land early. I'm right there with you. However, they very specifically chose that language. Early sounds a heck of a lot better than delayed in order to encourage people to take before their full retirement age because they're basically playing the long game. They'd rather pay you less money over a long period of time than everything or even more than you're due. Another consideration is if you do decide to take prior to your full retirement age, but you either continue working or have the chance to go back to work, the administration doesn't really like that if you're below your full retirement age. They put in place what's called the earnings limit or the earnings test. There are actually two of them. If you look to the left in that middle blue column or middle blue box, the number that's in the parentheses, 1950, that's what's referred to as the special earnings limit. And that's for the duration of the first year in which someone files. So let's just say I'm 63 years old. I file for benefits in September. If I continue working and I earn more than $1,950 in September through December, any of those months, I don't get my check for that month. And then the following year, it turns into what's called the regular or the normal earnings limit. And that's that bigger number up above, the 23,400. And that's an annual figure. At any point next year, I could earn $23,400. But if I cross that line, then they'll withhold $1 for every $2 that I earn above it. In the year that I'm officially turning my full retirement age, so the year I'm turning 67 or turning 66 and 10, both of these numbers get a lot bigger and the withholdings aren't quite as bad. Once you reach your full retirement age, that's the finish line. You want to take a benefit? You absolutely can. You want to work and earn $1 million a year? I'm certainly not going to stop you. There are no more withholdings at that point. And I think that's really the key word, that this isn't a tax or a permanent penalty. It's a withholding. So if this does wind up affecting you in some way, you'll get that money paid back to you, but it can be very incremental. It can take years for them to make you whole again. The good news is that this is only things that you're basically working for wages for, things that you're paying FICA taxes on, distributions from any of your investment accounts, pension income, rental income. None of that will count against the earnings limit. So that's your personal benefits, a bit behind the scenes about how they're calculated, and some considerations just for yourself. If you're married, though, there's some other options to consider. The first is if you happen to have a spouse, what options are available to them. That's where spousal benefits can sometimes come into play. And there are three important things to know about spousal benefits. The first is these benefits are always calculated off the full retirement age of the person who's going to be taking it. So let's just say that a different way. If my wife Katie wants to receive a benefit based off of me, it is always calculated off my full retirement age benefit. Regardless if I file at 62 with a reduction or I go to 70 and increase, it is always tied to my full retirement age benefit amount. Second key thing to know is I need to file. In order to make my spouse eligible, I need to either be in receipt of my own benefit or be on Social Security disability insurance. They call that a deeming qualification. Deeming simply means one thing needs to happen before another. In the event of a spousal benefit, that's the primary person taking their own benefit or being on disability. And the third key thing is 50%. The most a spousal benefit can ever be is 50% of the primary person's full retirement age amount. However, that second spouse needs to wait until their own full retirement age to first file to get 50%. If they're eligible younger and they decide to file, there's going to be pay cuts. So this could go down to 32.5%. I get this is tricky, so I'm going to bring in a couple of friends here. You might remember them from the 1982 John Cougar Mellencamp song, Jack and Diane. If you also remember the lyrics, Diane was a debutante, so we're going to say she was the higher earner of the two. Diane's full retirement age benefit is $10,000, so if she takes it 62, it's reduced down to $7,000. If she maximizes its age at age 70, it's $12,400. So we'll look at what happens for Jack depending on Diane's decisions. I'm going to let you know it's a bit of a trick question. Nothing changes for Jack. Because Diane's spousal benefit is always calculated off of her age 67 number, that 10,000, it doesn't matter whether she files at 62, 67, or 70. It'll only matter what age Jack is when he's eligible and able to file. So it'll always be $3,250 at age 62. It'll always be $5,000 at age 67, assuming that's the first time Jack was able to file for a spousal benefit after Diane claimed. I also recognize that situations aren't always as clear cut as they are for Jack and Diane. You might have circumstances where both spouses worked, which means they might have eligible benefits for both of them. Social Security is required to pay you out the higher of any two benefits you could be eligible for in a spousal versus personal situation. So if my wife wants to go get a benefit at 62 and I've already filed, they're going to look at her benefit, they're going to look at the spousal benefit, and they're going to give her the higher of the two, and she's not able to switch over to another benefit later. This can get tricky though, because a lot of times either lesser benefit individuals or younger spouses will file for their own benefit at 62 with the plan that later on, 5, 6, 7 years later, when their spouse applies, they'll get that spousal benefit. And oftentimes they're expecting the 50% because they're at or beyond full retirement age. Social Security is a whole separate calculation here if you file for your own with the plan to get a spousal benefit later, which is called the excess spousal formula. There's not much excess about it. It helps bridge the gap, but rarely, if ever, matches that complete 50% spousal benefit you could get. This is where I believe Social Security stops being just a me benefit, and if people are married, it becomes a we benefit. Anytime you're having a conversation about when you think you should file, you need your spouse right there next to you with their statement, so that way you can have a conversation about when someone's filing, what they're filing for, and if there's any other later impacts to other potential benefits. So that way you're making the most informed decision about how Social Security benefits are going to be taken and coordinated. Following spousal, sometimes there's a what if question. What if one of us passes away? What happens then? That's where survivor benefits come into play. And these are different than spousal. Survivor benefits are calculated completely differently. Oftentimes, these are sometimes just called spousal survivor. I'd ask you just to call them survivor or widower benefits to make sure the things that you're saying to Social Security get interpreted the right way. Survivor benefits are based off of one of two things, either what the deceased was receiving or what they should have been able to get. So I'll start with that first part. That means someone had the chance to file. So with the spousal benefit, it didn't matter what I did. It was always tied to my full retirement age. However, with the survivor benefit, when I claim matters. If I take at 62, I reduce not just my benefit, I reduce the potential survivor benefit as well, what that's based off of. I go to 70, I maximize. Survivor benefits also based off that increased value. So if someone was receiving a benefit, it's based off of that amount. However, sometimes folks pass away before they get the chance to file. That can go one of two different ways. The first way is if someone passes away prior to their full retirement age without filing. In that case, they're given the benefit of the doubt, and the benefit is based off of the full retirement age figure. And if people were trying to go from full retirement age to a later age, let's just say 70, but they pass away in between 68 and 2 months, in that case, they treat it as if that person filed the day that they passed away and they lock in that amount. Following this, survivors have some options available to them. If you look to the left here, you'll see that this chart starts at age 60. So that's before personal benefits, before spousal benefits. But again, as with all things Social Security, that gets a pay cut, so it can go down to 71.5% of what the deceased was either receiving or what they should have been able to get. But I really do mean that survivors have options. They could start with a reduced survivor benefit, maybe at 60, and then take their own at any point later, 62, full retirement age 70. They can grow their benefit all the way to 70, taking survivor benefit along the way. Or they could start with a reduced retirement benefit, maybe at 62, and switch over to their own benefit when that becomes, or sorry, switch over to the survivor benefit when that becomes larger up until full retirement age. Unlike with a spousal benefit, if you take one before the other in a survivor circumstance, it does not have a negative impact on the second benefit. And this can be really meaningful. The average difference between claiming at 62 versus 70 is an additional $11,000 a year. If folks are higher income earners, this is now an additional $20,000 a year. That can go a long way to helping pay for unexpected expenses, the rising cost of healthcare. The fact that when someone passes away, you're not able to get both benefits combined together. You're just able to receive one benefit. So if the survivor benefit is the larger benefit that's out there, the bigger it can mean an awful lot to the surviving spouse should something happen to somebody way down the line. Next up with divorce benefits, there's a lot of confusion around these. But this may not impact everybody, but if you've had friends or family that have gone through this, there is just a ton of misinformation about them. With divorce benefits, the first thing you need to know is that the marriage needed to have lasted 10 or more consecutive years to qualify for a benefit based off of an ex. Following that, spousal and survivor benefits basically look the same as if people were married. With spousal benefits, the max is 50%. You could start at 62. It's going to be the higher of either your own benefit or the divorced spousal benefit. The major difference is the deeming qualification is gone. Your ex does not need to file first in order to make you eligible. They just need to be a minimum age of 62 or be on disability. With survivor benefits, that works almost exactly the same way. The switch ups are also available. If remarriages occur, that's where things could get interesting. Ex remarries, A-OK. Doesn't affect you, your ex, or your ex's new spouse. But if you get remarried and you do it prior to age 60, you lose all the benefits based off the first person, and it's now either your own or based off of person number two. But if you get remarried after age 60, you keep the survivor benefit on that person available. So if you happen to know that husband or wife number one was Mr. or Mrs. Moneybags, and you're thinking about getting remarried, you might want to have a long engagement or just do a commitment ceremony and then go to the courthouse after 60. That way you'll keep that survivor benefit available. And if marriages end, whether it's death, divorce, or an annulment, you can become re-entitled to benefits based off of prior spouses. Now, lastly, with taxation, before I bring this on back on over to Ward, I think the first thing I'd like to mention about this is over the summer, there was a big overhaul of the tax legislation. In that, they were able to include extra deductions, which means a good bunch of folks that are on Social Security will have their taxation of Social Security reduced or erased. However, this doesn't mean that Social Security is no longer taxable completely. It's still federally taxable, and depending on the state that you live, could also be taxable at the state level. But here's how they do it on the federal level. They use something called combined income or provisional income. What this is the combination of adjusted gross income plus tax-exempt income plus just half of the Social Security that you're receiving. After that, they have brackets just about combined income to determine how much of your Social Security they could tax. I'm going to jump to the big one here, which is married filing jointly. If your combined income is above $44,000, they can include up to 85% of your Social Security as part of your taxable picture. So they're not taxing it at an 85% rate because that would be insane, but they're able to include up to 85% of it as part of your taxable picture. And if you're looking at $44,000 and adding those three things up in your head and saying, that's not hard, you're right. The last time they updated these numbers was in 1993. And in 1993, $44,000 was a lot different than it is today. There are a couple of things that are excluded from combined income. These are the 6 that pop up the absolute most. I'm just going to look at the top left-hand corner where it says Roth IRA or Roth 401k. The reason for this is usually within 18 to 24 months of retiring, folks go out and make a major purchase. Could be a car, a boat, an RV. My dad went out and bought a Harley Davidson that my mother never forgave him for. Here's why. My dad, A, didn't seem like a Harley Davidson kind of guy, but also he took the money out of his traditional IRA because that was his easiest pool of assets. It was absolutely fine. However, my dad had the potential to both fund a Roth IRA because of his income limits or do a Roth conversion if that made sense. Now, I don't normally suggest using Roth money to go buy fun things, but it might have made my mom a little bit happier when my dad disappeared for weekends on end with all of his new buddies if he didn't have to pay double taxes both on the bike and the withdrawal. I'm going to be pausing here in about 30 seconds to hand this back on over to Ward and Michelle. But my ask of you is when it comes to Social Security, start this conversation early. Before you're thinking about retiring, before you're thinking about taking Social Security, well in advance. We want to make sure your information, your spouse's, is up to date in your financial plan. So that way, when you do contact Social Security, you're going to be very confident about the choice that you're going to make and you know how it's going to integrate into your overall financial plan.